Hello students, welcome to the subject of project management. As part of this, we will discuss the lesson budget management and monitoring of the project. In this module, let us understand what is financial accountability and how it is used. It is the responsibility of an individual or an organization of the way money is used and managed. It speaks of the policies the organization should adopt to meet this responsibility and ensure that the organization is fully sound. The areas include finance, budgets, asset protection, and major risks. However, financial responsibility in project management mostly refers to managing of budget and finances related to the project. It is therefore essential to have an understanding of what the budget and finances are all about. Let us see the meaning of the budget. A budget is a key management tool for planning, monitoring, and controlling the finances of a project or organization. A budget is a statement of estimated results during a set time period, usually a year, expressed in financial and non-financial terms such as costs, revenues, and resources. At stated intervals during that period, actual performance is compared directly with the budget targets, and deviations are quickly detected and acted upon. Now, let us see the various types of budgets. On the basis of purpose for which budgets are prepared, they are classified. First, functional budgets. It relates to any function of the firm such as sales, production, cash, etc. The various types of functional budgets are sales budget, production budget, production cost budget, capital expenditure budget, selling and distribution cost budget, cash budget. Sales budget. It is a comprehensive sales program and plan for developing sales. It lays down the sales potential in terms of quantity, value, period, product, etc. Sales forecasting is the basis for preparing this budget. A sales budget is prepared by the sales manager with the assistance of salesmen and market research officers. The factors to be considered for preparing sales budget are population trend, consumers' purchasing power, price trend of the product, nature of competition, past sales, extent of advertising, etc. Selling and distribution cost budget. This budget lays down the cost of selling and distribution of the product during the budget period. It includes advertising cost, research and development cost, transport costs, etc. This budget is jointly prepared by the sales manager, advertising manager, and the distribution manager. Next is production budget. This budget is based on the sales budget. It lays down the quantity of unit to be produced during the budget period. The main purpose of this budget is to maintain an optimum balance between sales, production, and inventory position of the firm. This budget is also known as output budget. Next is production cost budget. This budget is based on the production budget. It lays down the estimation cost of carrying out production plans. Further, the production cost budget is subdivided into various sub-budgets like raw material budget, labor budget, production overhead budget, etc. The raw material budget lays down the quantity of raw material required for production during the budget period. This budget is prepared by the head of the manufacturing department. Labor budget. Labor budget lays down the estimates of labor requirements necessary to carry out estimated production during the budget period. It may include both direct and indirect labor requirements. In some cases, indirect labor requirements may be shown in the manufacturing expenses budget instead of labor budget. Production overhead budget. The production overhead budget gives the estimates of all production overheads to be incurred during the budget period. It breaks up the production overhead into three parts, that is fixed, variable and semi-variable. Next is capital expenditure budget. This budget outlines specifically capital expenditures for plant, machinery, equipment, inventories and other items. It also points out the plans concerning investment, expansion, growth, improvements, replacements, etc. Next is the cash budget. This budget gives the anticipated receipts and disbursements for the budget period and shows the cash position arising from it. It indicates the requirement of cash at various points of time and helps the management in planning and arranging cash to meet the needs of the business concern. Thus, it ensures that the concern never has any shortage of cash required. Cash budget helps the management in controlling and coordinating the activities which involve receipt and payment of cash. The next is the master budget. A master budget gives a summary of all the functional budgets and shows how they affect the business as a whole. In other words, it is compiled from various subsidiary or functional budgets. It provides detailed particulars regarding production, sales, cash, fixed assets, etc. The need for master budget containing a summary of all the subsidiary budgets arises because business concerns are too large to permit the detailed planning of all the aspects of the business in one budget. The budget management begins when top management sets the strategies and goals for the organization. Usually low-level managers will then devise budgets for their subunits within these guidelines and policies set by top management. The budget will then be reviewed by the superiors of these managers. The superiors will eventually integrate low-level budget into their own budget and send it up the chain of command for review. This process continues until the organization's overall budget has been approved by the board of directors. A budget department or budget committee may assist line managers in budget preparation and review. Budget management is done in 4 steps: defining the budget, executing the budget, controlling the budget, and updating the budget. Defining the budget. Defining the budget is done in 6 steps. First, setting objectives. The project manager is responsible for preparing the project estimate. Firstly, his plan should have set of objectives that should be budgeted, such as activities, human resources, procurement. All these in line with the guidelines and policies of the organization. These days, automated tools are being used for estimating the budget. However, it is always beneficial if the project manager has the checklist of every detail. The budget management plan can describe the authorizations, levels for purchasing, donor regulations or expenses not authorized by the donor. Next is analyzing required resources. Resource requirements involve determining what resources such as people, equipment, services and material and the quantities of these services are required to complete the project. For this, the project's WBS, scope statements, historical information, resource information, policies are used as inputs to analyze and determine the resources. Next is negotiating to estimate budget. Though the project manager is responsible for budget estimate plan, many others such as senior managers, low-level managers are also involved in preparing it. Hence, through many negotiations among them, 2 types of estimates are prepared, that is the rough estimate of overall budget and the definitive estimate using WBS. Next is reviewing the budget estimate. It is always better to have the same people who reviewed the WBS and schedules to review the budget. After reviewing, the project manager again interviews them to ensure that the budget is accurate. Next is obtaining final approval. Again, with many negotiations with the donors, depending on the size of the project, the final approval is obtained and contract is signed. Next, distributing the approved budget. Once the budget is approved, it is distributed to all the levels of managers. The second step of budget management is budget execution. Executing the budget is the action of authorizing the expenses approved on the project budget. The project manager then initiates to carry the activities that lead to hiring project staff, purchase of equipment, materials and services, all according to a project procurement plan developed during the resource management process. This step occurs after the budget has been approved and the project authorized to start its activities according to the project plan. At this moment, the finance department of the organization and the donor has established the disbursement schedule that will put financial resources on a bank account available for the project. The next step is budget control, a technique where the actual results are compared with budgets and any differences that are made the responsibility of key individuals who can either exercise control action or revise the original budgets is considered as budget control. Budget control is done through certain steps, that is standard costing establishment, assigning responsibility accounting, preparing financial statements, performing ratio analysis, and conduct internal and external audit. Standard costing establishment. The cost of production determines the profit earned by an enterprise. Standard costing can be used for the purpose of cost reduction and cost control. The objective of this is the same as the budgetary control. The system involves a comparison of actual with the standards and the discrepancy is called variance. The various steps in standard costing are setting of cost standards for various components such as raw materials, labor and overheads, measurement of actual cost, comparison of actual cost with the standard cost, finding the variance of actual cost from the standard cost, finding the cause of variance, taking necessary action to prevent the occurrence of variance in future. Next is assigned responsibility accounting. It can be defined as a system of accounting under which each departmental head is made responsible for the performance of the department. Under this system, each department is made a semi-autonomous profit center, that is a center responsible for the generation of profit. A department generates profits by selling its output to other departments in the same organization. These prices are called transfer prices. Next is prepare financial statements. The trading profit and loss account and the balance sheet of a company are the usual financial statements which are prepared ex post to indicate what financial events occurred since the last statements, for example, financial statement of previous year or quarter or month. Managers can use these statements to compare and evaluate their organization's performance with other organizations. Project managers too prefer to have their own records of the accounts. For large projects, the best known technique is the bookkeeping. Bookkeeping is the standard method for recording transactions in double entry manner. For small scale projects or personal records, a simple single entry analysis ledger is usually adequate. The ledger is used to record each item of income or expenditure and analyze by source and application. Periodically, most typically at quarterly or 6 monthly intervals, a formal set of financial reports should be prepared to compare actual expenditure against the budget. The report should be prepared for the project as a whole and for individual partners if they are separately managed. Summary reports should also be prepared to analyze expenditure by category and by source of funds. Next is perform ratio analysis. Ratio analysis seeks to extract information from a financial statement in a way that will allow an organization's financial performance or condition to be evaluated. It involves selecting two significant figures from the financial statements and expressing their relationship in terms of a percentage or ratio. The ratios most commonly used by organizations are liquidity ratios, which measure the company's ability to pay back short-term debts by converting assets quickly into cash. In other words, they are a measure of company's liquidity. It is expressed as current assets plus current liabilities. Another ratio is debt ratios. Debt ratios are computed to assess its ability to meet long-term commitments. The simplest debt ratio is total debt divided by total asset. This ratio tells us the proportion of the company's asset owned by its creditors. Another ratio is profitability ratios. These ratios express profits as percentage of sales or of total assets to depict the company's efficiency of operation. Next is operating ratios. These ratios measure how efficiently the manufacturing and sales are being carried out. The more common operating ratios are inventory turnover ratios and total assets turnover ratio. Inventory turnover ratio is obtained by sales plus inventory, and total assets turnover ratio is obtained by sales plus total assets. The next is return on investment ratio. It is also known as DuPont system of financial analysis. It is expressed by the ratio that is computed on the basis of capital turnover, that is sales plus investment, which is multiplied by earnings as a proportion of sales, that is profit plus sales. The next step in budget control is to conduct internal and external audit. Internal audit is conducted by an internal auditor who is an employee of the organization. He makes an independent appraisal of financial and other operations. In addition, he appraises company's policies, plans and management performance. As internal audit is conducted regularly, it keeps the employees always alert. External audit. It is an independent appraisal of the organization's financial accounts and statements. The purpose of external audit is to ensure that the interest of the shareholders and other outside parties connected with the company are safeguarded against the malpractices of the management. The external auditor has to certify the annual profit and loss account and balance sheet. The next in budget management is budget update. For most projects, changes to the budget need to be approved by the donor. In some instances, the donor can give the project a small percentage that the project can use to cover small budget modifications. In other instances, the donor may have strict limitations to allow budget changes. For example, the donor may specify that any unauthorized project expenses will not be covered by the donor and leaving the organization with the responsibility to absorb those charges. It is important that the project manager understands the donor contract clauses and monitors with special attention the accounts or the budget items that have restrictions. Not doing so may result in losses to the project and the organization. Other type of changes comes from causes external to the project that may limit the activities or work it needs to perform. Approved changes to the budget will need to be reflected in the accounting system used by the organization, and new project budget reports will need to reflect this change. Once the changes are approved, document the changes for future use. Also, communicate the changes done in the budget to the people that will use the information. That helps reduce the chances that work will be done on activities that have been either cancelled or postponed. Project monitoring is an integral part of day-to-day management. Its purpose is to provide the information by which management can identify and solve implementation problems and assess progress in relation to what was originally planned. Project management now has the important and difficult task of establishing sufficient control over the project to ensure that it stays on track towards the achievement of its objectives. This is done by monitoring, which can be defined as the systematic and continuous collecting, analyzing and using information for the purpose of management control and decision making. Monitoring is handled at two levels. First, project team to control day-to-day activities. Second, external monitors reporting to all parties involved in the project and making recommendations for decision making. Monitoring system is designed with certain steps. First is stating the project objectives clearly. That forms the basis for monitoring. Project objectives should be revised to ensure that they are clearly stated and remain SMART, that is specific, measurable, attainable, realistic and time bound. It would be helpful if stakeholders also have a review of project documents with the mentioned objectives. Second, review implementation procedures. In reality, the levels of details of information required and the frequency of reporting will vary according to the level of management. For example, project managers will need information about day-to-day activities, while the external monitor will require more summarized information about achievement of outputs or deviations from the work plan, which he or she may need to forward to the program coordinators. A review of implementation procedures involves a review of what activities will be undertaken and by whom. This should be done with reference to the activity schedule, that is WBS, used even for monitoring. Next is review indicators. It is for use in measuring achievements of objectives. Within the project implementation team, the priority focus will be on physical and financial monitoring of activities and outcomes. This is best done by good record keeping. Next is reporting. Project reporting is the formal presentation of monitoring information. Prepare reports to provide managers at different levels within the project with access to relevant and timely information, which facilitates easy analysis. Project managers will want to review progress very frequently, perhaps weekly or fortnightly, against their contracted budget and planned activities. Reports can be prepared using tools like WBS, CPA and PERT. Monitoring cannot be described as being successful simply because the required information is collected. The information collected must be communicated in the right form to the right person at the right time. Mechanism for communication must be established to ensure that the necessary information is generated and utilized in a timely and effective manner. Two types of mechanism for reporting are project progress reports and progress review. Project progress reports are periodic summaries, perhaps weekly, monthly or quarterly, of project progress incorporating key information from the physical and financial indicators included in the log frame, activity schedule, budget and cost schedule of the project. It is not sufficient for team members to report simply that things are going according to plan. They must also provide with the evidence. Progress review. Meetings on a regular basis are important to review progress against the plan. This may be an opportunity for written reports to be presented and discussed, or simply for a rapid oral assessment of current issues and problems. However, reviews can be damaging if they are too frequent or too drastic. It is also At times of crisis, that organizations focus more on task accomplishment and forget about the process. Better to build on achievements rather than just continually adjusting the plan. The next is to prepare an implementation plan for the monitoring system. This specifies the necessary staff, skills and training required and clearly allocates information collection and reporting responsibilities. This is all about the budget management and monitoring of the project. Any questions?
Ma'am, I have a question. Why is budgeting important in project management?
Without a well-planned budget, projects can fall apart, be left incomplete. Budget allows the project manager also to know how much he can spend on the overall project, thereby estimating and prioritizing the individual costs for different parts of the project. This also helps as a guide for future projects. Hence, it is very important to do the budgeting before you process the project. Any more questions? Hence, it is very important to do the budgeting and the monitoring of the project in project management. Thank you.